Okay, so we are recording this. So if you'd like to view it again, we will send out the replay. Let me share my screen. So thank you so much for being here today. My name is Glenelle Jordan. We have Kelly Tom on the call as well. And today's webinar is called Navigating Volatility. But I actually put an additional title in there called should I invest in the stock market now or should I wait? And it's a very applicable in our times today. And I get this question a lot. So I thought it was important to put that title in there so that we can help answer that question for some of you guys today. This is one of our monthly webinars. So we do webinars every month. And some months we bring in guest speakers. So we've had speakers on Medicare, and is it not next month, but the month after, we have a guest speaker, an estate planning attorney. If this is the first time to one of our webinars, you will get emails for future webinars. And if you ever want to see what we are doing this month, you can just go to our website at summitfinancialhawaii.com. Click on workshops, and you'll see what's coming up then. You can also go to our YouTube channel, Summit Financial Advisors, and you'll see the replay of our previous webinars there. Okay, so to get started today, we'll be going from 11:30 to 12:15. We'll be done 12:15 promptly, and I'm gonna speak first, then Kelly will go. So I've been wanting to do a webinar like this for quite some time. And I was really excited to do it. And the reason is, so, our specialty, probably a lot of you on the call know us, but if you don't, so our specialty is retirement planning. And majority of the clients that we work with are approaching retirement. Maybe they're like 10 years away from retirement, or maybe they've just retired. And so we work with a lot of these people into helping them develop their retirement plan so that they can retire comfortably, they can live the retirement they want to live, and they can feel good about it in terms of they have enough money and they know they're not going to run out of money. And, we see clients from, the range. And when I say the range, some clients are very prepared or maybe even over prepared. And then some are maybe not as prepared. And I'm always look at each client, and especially the ones that are prepared or even over prepared. And I think to myself, like, what did they do differently that somebody else didn't, that's not as prepared? What can I take from that to help pass on that education to my other clients, and especially the ones that maybe have more time, so that we can help those clients be as prepared as the ones that are prepared. And I think about this a lot and how I can, transfer this education to the general public. And, here's what I've noticed. A lot of people may think that you can retire early or you can retire with plenty of money because maybe you're rich. Maybe second thing is you've made a lot of money. You just had a really good income over your life. Maybe you're just really good at stocks and, picking stocks or picking mutual funds. The timing, like, when to get in and out. And in fact, those aren't any of the reasons why somebody is more prepared for retirement than others. In fact, it's the clients that, maybe haven't had the highest income, but have had a moderate income for most of their lives. Those are some of the clients, and they're just hard workers. Those are some of the clients that I see that are the most prepared in retirement. So what is it then? What is the secret sauce for being prepared and having enough money? And I find it comes down to four things, and you can break it into more, but it's kind of four basic things. The first one is they have a plan, and it doesn't need to be a complicated plan. It could be something like, I'm going to put away 10% every month, into this types of investment for this many amount of years. It could be as simple as that, but they have a plan. The second thing is they have an understanding of their own risk tolerance. And what I mean by that is they know how comfortable they are with volatility in the stock market. And from that, they know what types of investments to go into. The third thing is they have time on their side. Time is really, really, really important when you're investing in the market. And the fourth thing is, which is the most important, is they made a commitment. They made a personal commitment to themselves that based upon their plan and based upon their understanding of the stock market and of stock market volatility, that they're going to stick to it. And commitment is everything, and not just, whether you're saving or investing, but everything in your life. It's your relationships. It's a commitment, even when it gets hard, to continue on. With your health, with your, diet. If maybe you're trying to get to a certain place in fitness, it takes a commitment. Well, it's the same thing with money. And our job as financial advisors isn't so much to pick the best and the winning investment, but it's to help coach you and be there with you through thick and thin to help you follow on your plan and stick with those commitments. And based on that, that is what I've seen is what separates the very prepared and successful for retirement versus the not as prepared. So the goal for this presentation is to educate you guys on stock market and volatility. And you're probably like, well, what does that even mean? We'll get into that, and why now can be a good time to invest. But it's more so about your understanding of market volatility, which will dictate if now is a good time to invest or if you should wait. So I hope that preface makes sense, and we're going to get right into it. So just for you guys' information, this presentation, we did not create it ourselves. We borrowed it from Invesco. They are an investment company. So we want to thank them for letting us use their presentation. Okay, first I want to talk about what has been previous stock market and bond performance over the past 20 years from 2000 to
Sorry. I'm going to interrupt real quick. If anybody has any questions, please type it in the chat, and then I'll interrupt Glenelle when she takes a pause and asks the question. Okay, sorry about that. Thanks.
Yeah, thanks, Kelly. Yeah, feel free to ask any questions at any time. Okay, from 2000 to 2020, what has the market done? Well, US stocks, which is represented by the S&P 500, have done in this 20 years 6.6%. On the flip side, government-related bonds, one of the most conservative types of investments, have done 5.1%. And then there's inflation, and inflation is just the cost of goods and services around us going up. And the reason we put inflation here is because in reality, we need our money to keep up with inflation. If it's not keeping up with inflation, we're slowly losing it to this invisible enemy every year, 2.1%. However, the average investor has not even done as well as bonds, 4.3%. What does this tell us? This tells us that something's wrong. A lot of the average investors, they're doing something wrong. What are they doing wrong if they're not even keeping up with government bonds? And that's what we're going to talk about more today. A lot of the problem is the herd mentality. The herd is not always right. And what I like to tell people is, don't look at the news every day, because the news can lead you to act with emotion and make the wrong moves. Now, you may remember the tech bubble in the early 2000s. This is when technology stocks, they were all going up. So what did people do? Everybody wanted to make money because they heard other people were making money. So everybody rushed in, and this drove the price higher and higher and higher, but people still kept buying in, right? Because they think it's going up, it's going to keep going up more. On the flip side, now remember in 2008, and I say remember, but I know, how can we forget? It was the Great Recession. That was when the housing market collapsed and then stocks pulled back. Well, if you look at the bottom chart where it says Bear Stearns, Fannie Mae, what people were doing is they were selling after the market went down. People got really scared because nobody wants to lose all of their life savings. And so they were all selling out of stocks and buying into bonds. So that bottom chart is actually the inflow of bonds. And so they were selling after the market went down because they were fearful, and they were buying into bonds. And it's really interesting when we think about when people actually buy and sell investments based on emotions. Now, if you go to Foodland, we probably have the Mackay coupon or the Mackay card. And when something's on sale, it says 2 for 1. You're like, oh, great, it's on sale. I'm going to actually get 2 of these because I really like this particular, milk or whatever it is. And it's on sale, and I'm going to buy more because I can get more for my money. But with stocks, for some reason, people have the opposite mentality. And when the price goes down, that's when people run away. And instead, when the price goes down, it's actually a great opportunity to get into the market at this time. People always ask me, clients, friends, strangers that I just met, and I tell them I'm a financial advisor. They say, hey, what's the market going to do? Well, even though I'm a financial advisor, I don't have a crystal ball. I really don't know, right? I can just help you invest appropriately. So even though you might meet somebody somewhere that tells you, what's going to happen with a particular stock or the stock market in general, nobody really knows. And so one of the most important things you can do is to stay invested based upon your own personal plan, risk tolerance, and time horizon. Stay invested even during the most volatile periods where it feels like the world might be crashing down around us, where it kind of did feel like that when COVID first struck. On this left, this chart is probably one of the most important charts of this whole webinar today. And what it does, it looks at the S&P 500 over the past 25 years, from 1996 to 2020. Now, if you put $100,000 in the S&P 500 25 years ago, it would have had an annualized return of 9.52%. And that means it would have grown to $979,000. That's a really good return. However, if during those periods of volatility, and what are those periods? Well, there was the tech bubble in 2000, the financial crisis in 2008, and most recently, COVID in early 2020. So if you tried to maybe time the market or get in or get out at a certain time, and you missed just 10 of the best days of the past 25 years, and just think of that, 10 out of 252 trading days a year, 25 years, now your return would have gone down to 6.56%, just missing out on 10 trading days. And your money would only have been worth $490,000. If you would have missed, let's see, the best month, best 30 days, you would have barely kept up with inflation at 2.4%. And if you would have missed the best 60 days, you actually would have lost money. And so what does this tells us? This tells us the most important part of reaching your investment goals is to stick with your plan and stay invested, even in the face of uncertainty. And I know this can be really difficult to practice, when it's actually happening around you. But it's part of that commitment to sticking with your plan and going back to understanding your asset allocation and your risk tolerance. And if you don't know your asset allocation and your risk tolerance, that's a great conversation to start having with us or your financial advisor, to start talking about that and to understanding how volatility makes you feel. Just over here on the right, we have the recent market during COVID in early 2020, where the market went down quite a bit. But here's some of the top trading days. So during those periods of volatility where you're the most scared, that's where there's also some of the biggest opportunities. So the biggest return we had in March 24th, in one day, the market rebounded 9.4%. So that's why it's so important to stay invested in those periods of volatility. Here's something that I hear all the time. People say, you know, investing in the market is like gambling, right? And I'm not comfortable with gambling. Well, is it like gambling? Is investing in the market similar to going to Vegas, our favorite ninth island, and gambling? Well, let's look at the statistics and let's look at the odds. So on your left here, we have the various odds at winning at different casino games. Now, if you know me, you may have heard me say I am from Las Vegas, born and raised there. My mother was actually a showgirl. So while I know all the casino games, I'm not much of a gambler myself. But you might look at this and you might say, oh yeah, I like, poker or blackjack or whatever it is. So why does the house always win? And why is Vegas so successful? Because the odds of winning at these games are less than 50%. And anytime the odds or something are less than 50%, that means there's a bigger chance of you losing than winning, which is why the house always wins. Even the highest one, and this one, I don't even know, Baccarat, I don't even know what that one is. 48.8%, close to 50, but still under 50%. But what's great about Vegas is it's lots of fun, and the, what do you call it? Those food things where you can get, oh yeah, all you can eat for like $10. But we like Vegas because it's fun, whether or not we make money there when we go to Vegas. Now, is the stock market really like gambling? Well, let's look at the chances of having positive returns in the stock market. So what this does is it's looked at the historical from 1901 to 2020, about 120 years, and it's looked at rolling monthly returns. So what is a rolling monthly return? So it says from January 1901 to January 1902 is 1 year returns. A rolling return now is from February 1901 to February 1902. So that's what a 1 year rolling return is. So what they've done is they've looked at rolling monthly returns for the last 120 years. And for the rolling 1 year returns, 74% of the time there were positive returns in US stocks. 74% of the time. That's a high amount of time. Now, the 3 year rolling period, the 5 year rolling period, every time you have longer holding periods, the chances of having positive returns in stocks actually increases. And if you hold your stocks for 15 years, now the chances of having positive returns in your portfolio is almost 100%, 99.9%. So what does this tell us? This tells us that no, the chances, first of all, are better than gambling. But the second thing is the longer your holding period, which means the longer you stay committed to a particular investment plan, the higher your chances are of having positive returns in your own personal portfolio. That's why it's super important to stay invested even during times of volatility. Now, I know during this recent market drawdown, during COVID in March of last year, it really felt like the world was coming to an end. I have to admit, I felt extremely nervous, not just because of stock market performance, but because I saw the altercations of everything that would come down the line. Businesses would close, people would lose their jobs. How would people pay their rent? It made me sick to my stomach. That's exactly how I felt in March. And then, the market rebounded and, stimulus was passed, and we're clawing our way out of those times, right? And the market's reopening, people are getting their jobs back. But it was scary, and I felt just as scared as everybody else. But what's important to note is that scary times that we're in right now and that we faced aren't new. You know, humans, especially Americans, have faced very scary times in the past. You know, from the Great Depression to 2 different world wars to, you know, the tech bubble to the housing crisis. We've been in scary situations before, and we're resilient. Humans are resilient, Americans are resilient, and our economy is resilient, and we always find ways to come back and come back even stronger. This the chart you're looking in front of you, the dark blue is volatility. And so this is when you get the big swings, the big negatives and the big positives too. And as you can see, the light blue line is the Dow Jones, representing the stock market, keeps increasing in the face of all this uncertainty. So hopefully it gives you some perspective of where we are now versus the history to help give you more comfort, to show that we can get out of this, and we will. So that is the end of my section. Kelly, I'll make you the host?
Yes, please.
Okay.
Does anybody have any questions? Okay. Okay, so let's continue on with understanding the stock market. Volatility does not equal financial loss unless you sell. So a lot of times I hear, you know, so-and-so lost 50% in 2008. And I asked what happened, and they said, oh, the market dropped and they got scared and they sold out. And so that's when you actually lose, right? When you sell out of your portfolio. So here's a look at the S&P 500, the 500 largest companies in the stock market from 1984, every year until last year. And this light blue box on the bottom, it shows the largest drop of the market. So you'll see it's very often that there are drops, but these are just temporary drops, right? Many times the market comes back. We all remember last year, the market dropped as low as it dropped 34%. But had you held on and left it as is, you probably would have seen your portfolio get back to equal and probably even higher. The median drop over this past, 30-something years was 9.6%. The median annual return was 14.4. So leaving your money in, as long as you don't need it for a certain purpose, leaving it in, the average return was a lot higher. So these drops are all just paper loss is what we call it, right? You see the loss on paper, but only when you sell it do you actually realize that loss. So keep that in mind. When we see the market dropping, of course, it's not a fun feeling to see it. But if you have no need for the money, then it might make sense to just leave it and wait it out and let the market come back. So stocks actually outperform most asset classes over time. And so let's look at this on the left side first. This is the growth of, let's say 100,000 was invested in 1978, and looking how that 100,000 did up until last year. Real estate, and this is an average on the, throughout the US. So I know Hawaii real estate is a little bit different, but just to give us an average perspective, 100,000 invested in a real estate property in 1978 would have grown to about 606,000, let's call it, in 2020. Gold, 100,000 invested in 1978 would have been worth 858,000 in 2020. Bonds, a little bit better actually, would have been worth 1.1 million. And see, as we get here towards the front, actually small cap stocks perform the best. Had we invested 100,000 in 1978, it would have grown to 13.5 million as of 2020. And so for investors with a growth objective, there are few, if any, better alternatives to stocks. And of course, we're not saying invest everything in stocks. This is more money, for retirement or something that you have a longer term horizon. But just to give us perspective, because we all see the market drops, we all hear, I think we all remember the bad news more than the good news, right? That sticks with us more. So we hear the market dropping. But stocks actually do well as well. And so seeing this is how stocks, even the larger company stocks like Apple, Google's, investing 100,000 back in 1978 would have grown to about 12 million. And this is the amount of time stocks outperform bonds. And I know a lot of us are used to bonds because it's backed by the government. We get a set interest rate. It doesn't fluctuate as much as stocks. And so they're a nice alternative. And bonds certainly have their place for you want something more on the conservative side. And you might need the money sooner. So bonds might be the smarter thing to do for a certain reason. But just to give us perspective as well, looking at rolling periods from 1978 to 2020. So same thing, January 1978 to January 1979, February 1978, February 1979, March 1978, March 1979. So they did that this whole time from 1978 to 2020, every month. And then they average out to see how did it do. And stocks actually outperform bonds over a 1 year period 69% of the time. And then when they do a 15-year average, so let's do a 10-year average, on January 1978 to January 1988, February 1978 to February 1988, and such, on. And then same thing for all the other years, right? It's just a longer time. 15 is a longer time period. And you'll see all scenarios here, majority of the time, stocks outperform bonds. And so if you're looking for the growth, stocks would be a good option. And this doesn't mean, we all say history is no indication of the future. So it doesn't mean it's going to do the same going forward. It doesn't mean small cap stocks are always going to do better than real estate or bonds. This is just giving perspective to see how it has done and give us an idea of maybe what it could do in the future as well. History tends to repeat itself, but it's not always. So just keep that in mind. And that's why we bucket our money, right? We put some money in, let's say, stocks that you might need a long time in the future, some money in bonds that you might need in the near term, leave money in savings for money that you're going to need right away. So new highs, I remember every time we're like, whoa, the Dow hit 20,000, the Dow hit 30,000. Oh, the S&P 4,000, every time there's a new high, it's like, wow, how amazing, right? Is it going to drop? I mean, it's kind of natural that every time there's a new high, there's a drop, right? We look back at 2000, 2001, the tech bubble, right at this peak, we're like, wow, this is such a big peak. It's going to drop. And it did drop. 2008, the market was climbing again, and then it dropped. And here we are again. So new highs, they're actually becoming the norm nowadays, right? If you kind of look at the chart, this is not the best chart to see, but of a chart of the S&P 500 from when it started to now, it is an up and down, but the general trend is up, and you can see it here, right? The general trend is up. So yes, there always will be corrections, just like we saw last year, but just hang in there. And as history has shown us, the market has always come back up. So a bear market, a prolonged period of when the market is down, it is scary, but it doesn't have to be devastating. So the Dow Jones Industrial Average, annual total return since 1901. So from that time till now, 89% of the years, it had a positive, of those past 89% of those years, it was positive 74% of the time. And it was negative 26% of the time. So even though it had negative returns 26% of the time, the average annual return was 11.5%. That's pretty good, right, for having that much years of negative returns. And it's just, what happened was, it's just when it drops, you wait it out, it comes back up. And so that's why the average is what it is. Looking at drawdowns now. So this is from 1945, average index drawdown. So to give you an idea, from that time, the market dropped between 5 to 10%, 41 times over from 1945. Okay, so it dropped between 5 to 10%, about 41 times. And for it to recover to get back to where it was, it took about 3 months. Not bad, right? When it dropped between 10 and 20%, that happened only 15 times. And to get back to where it was, it took 8 months. And this is the average time it took to get back to recovery. So of course, sometimes some years it took a lot longer, some shorter, but average 8 months. When the market dropped between 20 and 30%, it only happened 5 times. And it took a little longer. Average time it took to get back to normal was 27 months. So a little over 2 years. And when it dropped more than 30% to 60%, it happened 6 times in the past. And to get back to where it started, it took 52 months. So drops do happen. And like this shows, it has always come back. And so this is why it's important to look at your time horizon, right? If you want to go for growth, by all means, but make sure you're not going to need that money soon, because in case there's a big drop or drawdown, like we see here, we want to make sure that you have the time to come back. And as we saw in the previous slide, right, it drops, but if you have that time, it will come back, right? That's how it has always done. So hopefully it does the same thing in the future. So asset classes, so this chart, I know it's a lot of numbers. What this is trying to show us is that this is the average returns for different asset classes, and I'll walk you through it. So on the far left, it's from 2009, and then each year, 2010, 11, 12, all the way to 2020. And at the top is the best performing asset class, to the bottom, which is the worst performing asset class. So we'll see in 2009 emerging markets. So these are countries that are not developed economies that have good potential for growth. These are more like China, India, Brazil. Their economies are still rapidly growing and still have good growth potential. They actually performed 78% in 2009. Let's look at 2010. It did about 18%. So it was the 4th top performer. 2012, it did good. But now let's look 2013. It was one of the lowest performers. It lost 2.6%. 2018, it was a worst performer. It was down 14.5%. Let's look at large cap, US large cap stocks. These are the Googles or the Apples of the world. It did decent, 26%. But you'll see if we follow where it did 15%, 2%, 16. And so all of these sectors, it's all up and down, right? None of them does the best all the time. None of them does the worst all the time. So a lot of people, when they think about investing, they say, okay, oh, what's doing good? Or what did good last year? That's what I want to go into. And that's probably not the best thing, right? Because as we can see here, though emerging, if we look 2010, what did good at emerging markets? That's probably not the best thing, because look, next year, 2011, it did the worst, right? And so what we like to see is looking at a globally diversified portfolio, usually like a 60% stock, 40% bond portfolio. It helps smooth out the ride. So you'll see there's not going to be as much peaks and not as much valleys, right? So it's never going to be the best performer nor the worst. And so it's a much smoother ride. The returns, though not the best, it doesn't take as much to come back because it's not going to have huge losses like this. And so asset classes, they always, some years it does good, some years it does bad. And so what we highly recommend is a diversified portfolio, investing for what your goal is, what your time horizon is, what you're going to use it for. That would be the smarter thing to do. Okay, so that's it. Does anybody have any questions? Oops. Sorry, I'm going to leave this up here.
Any questions?
If you guys have any questions offline, this is our contact information, our website as well on the bottom. And thank you for joining us today. Today was a little bit more technical, but we wanted to give more insight about what does the market do, because maybe that'll help or give us insight of how it's going to do in the future, how to help us feel calmer when markets fluctuate. And the big question we get a lot too is, should I invest now or should I wait, right? So hopefully this gives you kind of some food for thought. Of course, everyone's situation is different. And so if you have any questions, please feel free to reach out to us. We'll be happy to help you. So now, anything you want to add?
That's all. Thank you guys so much for attending. Have a wonderful day. Bye.
Bye.